Volkswagen Group's third quarter operating profit and margin shrank to the lowest since the COVID-19 pandemic, as high wage and energy costs, lower demand, and expensive investments in new models, including EVs, weighed on earnings. Operating profit fell 42% to 2.86 billion euros, or $3.1 billion on 78.5 billion euros of revenue in the quarter, VW said in a statement. Operating margin dropped to just 3.6%. Group profits were hit by a weak performance at the VW brand, along with high costs in its German home market and investments in new models. VW said the results reinforced the need for drastic measures in Germany, where labor leaders are resisting the potential closure of at least 3 factories and the elimination of thousands of jobs. The company is also looking to reduce wages for around 140,000 workers by 10%. The core VW brand, where much of those cuts would fall, earned a 2.1% operating margin in the first 9 months, compared with 3.4% in the same period last year. This highlights the urgent need for significant cost reductions and efficiency gains, VW Group Chief Financial Officer Arno Antlitz said during an earnings call on October 30th. VW never had really high margins over the course of times, but these are different times, Antlitz said. VW is not earning the money it needs to spend for all the new products. He said the automaker has spent 4.9 billion euros on development and investments for the EV transition, bringing down VW brand's earnings to 1.3 billion euros by the end of September. Antlitz reiterated that the VW brand needs to reap more than 10 billion euros in cost savings to stay competitive with peers. He warned it will be challenging for the company to comply with stricter limits on CO2 emissions in the European Union next year, and said VW may need to pool its fleet with another manufacturer. He said he was confident that the company could reach an agreement with workers, but could not rule out strikes. Antlitz said VW expects a stronger end to the year as new models enter the market from all the group's brands. Order intake in Western Europe for the first 9 months was up 9%, compared with the same period last year, providing a tailwind for the final quarter. VW expects the group's global deliveries for 2024, including brands such as Audi, Porsche, and Skoda, to be around 9 million vehicles, down from 9.24 million in 2023. It expects sales revenue to be around 320 billion euros, down from 322.3 billion euros in 2023. It forecasts a group margin of around 5.6%. The European car market has shrunk by about 2 million vehicles since the pandemic, resulting in about 500,000 less unit sales for Volkswagen annually. Players such as Tesla and Chinese car makers offering cheaper models have gained market share in Europe. In China, Volkswagen has also lost market share as local competitors offer cheaper models, and this has been exacerbated by a wider slowdown in the Chinese economy due to a real estate crisis. VW cautioned that operating profit from its joint ventures in China may end up toward the low end of its forecast range for the year, at around 1.6 billion euros instead of as much as 2 billion euros, but it's in China where the competition really heats up. VW is losing ground to local giants like BYD and Li Auto, prompting some strategic shifts. They've announced a partnership with XPeng to produce 2 new electric vehicles under the Volkswagen brand, using XPeng's software and EV tech. This is a crucial part of their new In China for China strategy. Volkswagen's situation is a microcosm of the global automotive landscape: intense competition, shifting demand, and the urgent transition to electric vehicles. How they navigate this will be crucial not just for VW, but as a signal to the entire industry. Can VW survive these turbulent times and pull themselves out of this nosedive? Or is this just the beginning of the end for VW? Let us know your thoughts in the comments below. This is Kevin Liu for Todo Machina. Thanks for watching.